Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 127. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Thank you, Richard. Well, it's been a busy 4 days since we last did a Portfolio Matters, and in that time, last night, the Bank of Japan allowed 10-year bond yields to rise above their previous limit of 0.5%, and that caused a sell-off in US bonds and equities, and the sell-off in bonds has spread to Europe this morning. Earlier in the week, the Fed raised rates by 25 basis points to a range of 5.25 to 5.5% and said that further rate rises were possible but would be data dependent. The ECB raised rates by 25 basis points to 4.25%, and Christine Lagarde now thinks the ECB is done. US GDP for Q2 came in hot at 2.4%, and frankly, all the data which we will show you shows that US economy continues to tick along just fine at the moment. The IMF has therefore upgraded global growth forecasts. It believes the UK will escape recession and the EU will escape recession, which seems extraordinary, given that it looks like the EU is rapidly falling into recession. And we'll show you the PMIs, which were poor, particularly in the Europe and the UK. And finally, the UK government faces a £150 billion bill to cover the Bank of England's QE losses, which is something we've talked about before. So this is the Japanese 10-year yield. And as you can see, previously it was capped at 0.5%. And as of yesterday, it's being allowed to move into a range of between 0.5 and 1%. And that caused a sell-off in global government bonds, as presumably the market is concerned that higher Japanese bond yields will reduce the flow of Japanese yen into the rest of the financial system to buy higher yielding government bonds elsewhere. Now, the IMF has upgraded its growth forecast for the world, and you'll see it now believes the Eurozone will have growth of just over under 1% this year, and the UK will escape recession. And this is the ECB's interest rate, and that has risen very quickly. And the US interest rates, again, very fast rate rises, and we are yet to see the full effects of those. And the Fed's rate rise was as predicted and has had very little effect on the yield curve. So the market now believes the Fed is done. Okay, on to this week's economic data. Richard.
Thank you, Keith. So the UK S&P Global Manufacturing PMI was down slightly and continuing the downward trend that it started about 18 months ago.
Yeah.
Not looking good for UK manufacturing.
Yeah, new lows for this cycle.
Yeah. Well, is it manufacturing is about 15% of the UK economy now? It's not very big, is it, in comparison to what it was 50 years ago?
No.
UK Global Services PMI, however, although it's down on expectations, it is still within the range that it's been in for the last couple of years, but it's trending towards the bottom end of that range. I think if it drops much below 50, we'll be out of the range, and that will look unpleasant. So here we have the UK, the composite PMI, which is looking a little bit unhealthy, but because services are such a big part of the UK economy, it looks more like the services graph than anything else.
Yeah, but the bigger picture, Richard, is that bounce we've seen first half of the year is fading.
Yeah.
And as we've been discussing, the negative effect of that rapid rise in interest rates takes time to come through. And so I think we're now on a downward trend for the second half of the year.
Yeah, I would agree with that, Keith. The UK factory orders is up and is better than expectations, significantly better than expectations. And it has had a couple of up months. So we will see.
Yep.
And manufacturing optimism above zero, and hasn't spent much of its time above zero actually since 2018. So that's interesting.
It is.
And the UK CBI distributive trades survey is down and not looking very healthy, I have to say.
That was a big miss.
Yeah, and it looks like it's on its way down to something more akin to -40 potentially.
Yeah, and as the commentary said, expectations for the month ahead fell to -32 from zero last month, the weakest reading since March 2021.
Yeah,
retail sales in the UK look like they're deteriorating fast.
So this is a reflection, presumably, of the loss of disposable income because of inflation.
Yeah.
The EU HCOB manufacturing PMI looking pretty awful, I have to say. Worse than expectations, worse than June, and on a really steady, steep downtrend.
Yeah, and 42.7 is a terrible reading. That's deep recession.
And the same survey services PMI looking better, but nevertheless falling towards 50.
And worse than expectations.
Yeah. And there's the composite, which shows how much influence services has on the overall economy.
Yeah, but the big point is that it's below 50, so in contraction for the second month in a row and falling.
It makes you wonder where the IMF got their numbers from, doesn't it? I mean,
it does.
Part of their role, I suspect, they think, is to talk the economy up and not to talk it down.
Yeah, I think that's true.
So the Eurozone PMI employment and backlogs of work. So the composite employment index is falling. It's still in a sort of fairly positive range in terms of historic data. And the composite backlog of work actually is looking rather unhealthy. It's fallen to almost to the January 12 lows. And there's a big gap now between employment and composite backlogs of work.
Yeah. And if you look historically, when that happens, employment tends to follow the backlog down, but with a lag.
Not the other way around.
Yeah.
EU household credit growth is falling quite fast, having risen steadily, really, since 2013. So that suggests EU consumers drawing in their horns. And here we have US GDP quarter on quarter annualized. It's nice and steady between 2 and 3%, and ahead of expectations.
Absolutely. Actually, quite a big beat. And if you dig into the numbers, the reason it beat was primarily a big increase in investment, and particularly fixed asset investment and equipment, which is good news. It suggests that US companies are investing for the future, but we know a lot of that is semiconductor equipment incentivized by the CHIPS Act. Now, if you look at residential investment, that's falling. The other contributor was the government, which continues to increase expenditure. Now, if we look at that graphically, you can see that the GDP in Q2, there are big contributions from fixed investment, and government was positive. Consumption fell sharply from Q1. Now, before we all get carried away by the strength of US GDP, there's this comment from Eric Hickman at Lantern Capital. It is normal for GDP to be strong ahead of recession. In July 2000, second quarter GDP was 5.2%, well above survey expectations of 3.8%, and the recession began 8 months later. In October 2007, third quarter GDP was 3.9%, above survey expectations of 3.1. The recession began 2 months later. And when we look at the fiscal impulse and its contribution to US GDP, well, the US deficit, as we've been covering, has been growing very fast, and that has boosted US GDP. But if you look at the Congressional Budget Office's forecast for the fiscal impulse, and this was made about 3 months ago, you'll see it is peaking. And so that boost from fiscal policy should start to fade. And this chart was put together before the Biden administration lost the High Court battle over student debt repayments. So student debt repayments now begin on the 1st of September, and that will mean that the fiscal impulse will turn strongly negative from when those payments begin. Richard.
So US inflation is continuing to fall, so significantly better than expectations. And US core inflation is also falling from over the last few months from 6% to 4%, and again, better than expectations. Personal consumption expenditure quarter on quarter in the US is down, and it's a lot down from last quarter, but also a lot down on what was the expectation, which suggests that the economy is actually starting to slow fairly significantly, and analysts are getting caught out by that.
Yeah, the thing is that Q1 was boosted by very strong January sales due to good weather.
US global manufacturing PMI up against expectations, but it's still in that downtrend. It hasn't broken out of that yet, so we shall have to see where it goes from here. But there is continuing effect on the US economy of the interest rate hikes, so which haven't fed through yet. US global services PMI is looking like it had it had a bounce, didn't it? It was on a fairly steady downward trend, had a bounce. It looks as if that bounce has turned over.
Yes.
And below expectation now.
Yeah. So bear in mind that Q2 GDP numbers, I mean, those are all historic. And, during the last 3 data points, services were doing quite well. But the July number suggests services are weakening again.
Yeah. And the composite PMI is basically not looking, it's above 50. It's worse than expectations. And it doesn't look great, I have to say. US durable goods orders very much up against expectation, actually, hugely up against expectation.
Yeah.
And a very good reading.
Absolutely. But my US fund manager friend warned against taking too much away from durable goods orders because they're heavily influenced by aircraft.
US case-share house prices year on year having plummeted. This is the rate of growth, having plummeted from a sort of 20% rate of growth. It's now slightly down, not as bad as expectations, but basically house prices have now started to fall very slightly. And month on month, house prices are rising.
Yeah. No, they've come back amazingly. They've come back in the last few months.
Yeah. US new home sales better than expected, but still down, and actually a long way down from May's figure. It's hard to know whether that's just an artifact of the data, though.
Yeah. Well, last month, we reported this enormous 12.2% rise in new home sales. Well, that turns out to be wrong. It did rise, but only by 6.6%.
Yeah. And I think 1 month of this data, if you look at this data, 1 month is hard to draw any conclusions from. US new home sales have been on the up for a little while, but now just a little tick down. We shall have to see, but they were down against consensus.
Yeah, but when you look at the long-term trend,
Yeah,
the absolute level is absolutely fine.
yeah, exactly. And US Consumer Confidence Index on the rise at the moment.
Yeah, I struggle to understand this, frankly, because we saw earlier that retail sales are rolling over, and other data we're seeing shows that the US consumer is increasingly weak, but the consumer confidence number actually looks pretty good.
Yeah. And the Chicago Fed National Activity Index is quite a long way below expectations. I mean, it doesn't really work, but it's a factor of 10 below expectation.
Yeah.
But it doesn't look healthy, does it? I don't really know what this measures.
Well, it measures national activity, but frankly, given we have just had Q2 GDP, which came in hot, well, if you add up those last 3 months, they're
not hot.
They're not hot. So I wonder whether we should bother reporting this in future, frankly.
Yeah. The Richmond Fed Manufacturing Index on a steady downward decline still. It hasn't broken that trend that's been in place for the last 14 months, 16 months. And the Kansas Fed Manufacturing Index basically showing the same thing as the Richmond Fed, and down a lot below expectations, much worse than expectation.
Yeah, we're getting lots of contradictory data there. Remember, the durable goods orders were great.
Yeah.
So,
US Johnson Red Book retail sales just fallen below zero. And that steady decline has not ceased. US MBA 30-year mortgage rate back up basically at the peak of 7%, hanging around there. And the mortgage market index has stabilized at 200. US initial jobless claims are doing exactly what the Fed doesn't want them to do. They are falling.
Yeah.
And continuing jobless claims also falling gently.
Yeah, although, last week we showed you the non-seasonally adjusted number.
Yeah.
And that was, clearly rising. So it's an open question about, how much the seasonal adjustments are distorting these numbers. But whichever way you cut it, is not a huge increase in jobless claims. China
manufacturing profits year to date looks a little bit on the low side, but it's not. I would say it's not definitive yet. Well, there's 50. Yeah, it's worse. We know where we think the Chinese economy is going, but it hasn't got there quite yet.
Yeah, well, daily profits are down quite substantially year on year.
Yeah.
Okay, thank you, Richard. So in summary, UK PMIs were pretty poor. Manufacturing fell to 45, which is deep recession territory. Services faded to 51.5, and the composite is 50.7, which is just in expansion territory, but fading. Also notable was the CBI retail trades survey, which showed a sharp drop in July. The only good news was that factory orders bounced slightly in July to -9, and surprisingly, manufacturers were optimistic about Q3. Bottom line, UK economy appears to be slowing towards recession as that very sharp rise in interest rates, which is not yet over, starts to impact the economy. In the EU, well, the EU looks like it's already in recession. Manufacturing PMI fell further to 42.7, which is awful. Services fell to 52, and the composite was 48.9. The second month in a row it's been below 50. Household credit also continues to fall. And there was no positive data for the EU this week. So Christine Lagarde raised interest rates by a further 25 basis points to slow the economy. And given the lags that we know in monetary policy, frankly, I think her job is more than done. Now, in the US, we have much more contradictory data. US GDP came in hot at 2.4% annualized against 1.8% expected, and that was supported by business expenditure and business investment and fiscal expansion. Now, will those two carry on? We know that the fiscal expansion should turn into contraction later in the year as the student loan repayments recommence. Good news was that the quarterly PCE and core PCE inflation data were both weak and showed that inflation was fading towards the 2% target, although there's still some way to go. Consumption expenditure looks weak. In Q2, it fell to 1.6% annualized. The Johnson Red Book retail sales data, which, reminder, compares same store sales year on year nominal, fell to minus 0.4% year on year and is still falling. But the Conference Board Consumer Confidence Survey showed consumer confidence bouncing in July, which seems to contradict the retail sales data. Manufacturing PMI recovered to 49 in July, which is still in contraction territory, but much better than in June. And durable goods orders showed an astonishing bounce of 4.7% in June. But the regional Fed manufacturing PMIs for July continue to fall. So what's going on? New home sales are fading but remain strong, and there's no sign of an increase in unemployment claims. So lots of contradictory data, but once again, forecasts look weak. The actual data looks resilient. And finally, China, well, only one data point this week, and that showed that manufacturing profits fell 16.8% year on year. Growth is weakening. This week, there were talks coming out of the Politburo about boosting the Chinese economy. We have a section coming up. Okay, and onto one chart. Now, this is the economic surprise index for the EU and the US economies, which have diverged over the past 6 months. And that shows you all you need to know, essentially. We think the Eurozone and the UK are heading for quite an imminent recession over this period. While the economy in the Eurozone has been fading and missing expectations, the Eurozone has been tightening monetary policy. In the US, they've been tightening monetary policy, but the economy has actually surprised the upside. In the Eurozone, we think that recession is now inevitable and probably deep. In the US, think that the fiscal impulse will turn negative in this second half, and the lagged effect of monetary policy will start to bite. We're going to digress into meteorology now, because we have had this heat waves in Southern Europe, which are affecting lots of commodities, amongst other things, will affect the economy. Now, everywhere you hear commentary saying that extreme weather events are going to become much more likely. Is that true? So, reminder, temperatures in Sardinia in the last couple of weeks have hit 47 degrees C. We've had wildfires in Greece, etc., etc. Now, I have been trying to understand what's going on. And in order to understand what's going on, you need to understand the jet stream. Now, what is the jet stream? The jet stream are very strong winds high up in the atmosphere. So when I say strong, they're blowing at 200 miles an hour. And these streams are hundreds of kilometers wide, but only a couple of kilometers deep, and have been likened to ribbons. So what causes the jet stream is the strong temperature differential between cold polar air and warmer southern air. Now, this bit's slightly complicated, but if you imagine two columns of air, one column air in the warmer southern region and one column of air in the polar region, at the top, those columns of air hit the tropopause. Okay, so they're bounded by the tropopause. Now, cold air is denser and tends to fall. Warm air, less dense, tends to rise. And what that means is, if you think about the air pressure at the top of these columns, in the cold air column, the cold air will tend to fall within the column, meaning that the pressure at the top of the column is low. In the warm air column, the air has been rising and the pressure is higher. So air will tend to flow from the high pressure region to the cold pressure region. So you get a strong wind from warm air towards cold air. So you would naturally tend to get winds flowing from the south to the north in the northern hemisphere, from high pressure to low pressure. But the Earth is spinning. And so as those winds try and flow north towards the cold air, they get diverted in an easterly direction. And so what you then get is very strong winds at the intersection between the cold polar air and the warmer southern air. And those winds are the jet stream. But I'd liken the jet stream to a river in that it gets knocked off course. It doesn't flow in a straight line. It gets knocked off course by thermals coming up from the land and from the sea. And so you get this meandering pattern. And that's important, because what normally happens is hot air coming off the land is blown away by the winds in the upper atmosphere. And so hot air does not tend to build up down on the ground. But what happens when the jet stream meanders is it creates a loop, and then hot air does not get diverted by strong winds in the upper atmosphere. It gets trapped within that loop. And that type of weather pattern is called an omega block. Remember that the air coming up from the land is trapped at the top by the troposphere. And so what you get is what's called a heat dome. So hot air rises up from the land. It can't penetrate the troposphere, and more hotter air coming up then forces the already warm air down again. You get this feedback loop. Pause, have a read. So within the heat dome, you get higher and higher temperatures, and that's what's been happening in Southern Europe and in the US in recent weeks. So the big question is, are those extreme temperature events going to become more common? Well, I've read a lot about how the weakening of the jet stream will tend to make those weather events more common. And this is the extent of the Antarctic sea ice this year. So what's happening is the poles are warming more rapidly than the equator, which means the temperature differential between the warmer regions and the polar regions is being reduced, which reduces the strength of the jet stream. So how will that affect these extreme temperature events? Well, The bottom line is nobody knows. Blocking patterns actually need a strong jet stream to keep weather patterns locked in place. And the weakening of the jet stream will tend to actually reduce those blocking patterns. But against that, the weaker jet stream means that it can also be knocked off course and form these large meanders and blocking patterns more easily than previously. So I think the summary is we don't know yet. It's not sure. We're not sure whether blocking patterns, which cause extreme weather events, are going to become more common. What is certain is that when those blocking patterns occur, extreme weather events are going to get worse. Was that clear, Richard?
Yes, Keith, that was very interesting. And it's not good news, is it?
It's not good news. And actually, if you look at the temperature in the North Atlantic this year, just absolutely extraordinary.
Yeah.
Really shocking. So climate is changing. On to Inflation Watch, Richard.
Thank you, Keith. Some recent changes in interest rates. US is now in a range of 5.25 to 5.5%, and the EU 4.25%, as we discussed. Inflation is down in 3 of the major economies. Germany and Japan is up. And core CPI is also up in the EU, suggesting that inflation is not yet beaten. And I think this is why central banks are continuing to raise interest rates. They are not comfortable that inflation has been beaten yet. Until recession strikes, which it hasn't yet, although it probably has in Germany, inflation will not be beaten, I think.
Yeah. Well, we have some charts coming up, but I think that, the incentives for central banks are that they need to show that they're doing something. Because we know that they're huge lags. I think the ECB has actually done more than enough.
But having said that, inflation has peaked everywhere and it is falling, generally speaking, everywhere. We don't have a graph of German inflation here. But it is still, if you look at 3-month annualized rate on the right-hand side, it is still significantly above the central bank's 2% target. And I am mindful of the fact that there was that piece of where I referred to again last week by research affiliates that says historically inflation doesn't go up and then down and that's done. It oscillates for a number of years. And if that is the case, then we have a number of upswings to go before inflation is finally brought back down to a low level, if that's the case. Public interest in inflation has dropped, judging by Google searches, or maybe they all know what it is now.
Yes, I'm sure they do.
And Eurozone CPI services inflation continuing to rise with no significant change in that pretty steep upward trend there.
Well, this is your point, Richard. That the some elements, anything, wages continue to be strong, and so service inflation is just way above target.
This is why the ECB has raised rates again. So there's
so this is core services, still way above target.
So EU money supply growth is approaching 0, and according to economic orthodox, inflation should follow it down. So here are the contributors to Eurozone inflation. We can see that energy has effectively dropped out completely now. Food, alcohol, and tobacco are not as big as they were, but are still substantial. Services is large and continuing to grow, and non-energy industrial goods are stabilizing, I would say. So the current bad boy is the services inflation.
Yeah.
And US core service inflation, excluding shelter, is falling quite quickly.
Yeah, great news.
Not European. US true-flation is up at 2.6% from its recent lows. Could argue it's just a little bit of a variation in the stats. And the Cleveland wage growth tracker is slowing, but still a long way above a sort of sustainable 2 or 3%.
Yeah.
And US consumer expectations are falling. I think we talked about this a couple of weeks ago. Then they're continuing to fall. But the number of small businesses in the US planning to raise prices in the next 3 months has increased. And that hasn't yet impacted the inflation data, obviously. But that is a sign that inflation has not yet been. UK truflation has stabilized. That's 11.4%, 11.5%.
Not good.
Not good, really unpleasant. And fuel price inflation picking up again. Of course, the oil price is rising, so that is going to be feeding into inflation figures over the next few quarters. And that is going to be driving inflation everywhere up.
Yeah.
And as I say here, it was a big contributor to inflation, then it was a big contributor to disinflation, and now it's in danger of becoming a big contributor to a second round of inflation. And here we have that chart showing inflation tends to come in waves, and it's not a once and done. So we're not there yet. And an inflation price above 7%, this is recreating, I think, the work that we talked about a few months ago. You have waves of inflation that continue for years if you have a sharp spike in inflation. And I don't see that this should be any different.
Yeah. No, I think you can work out what goes on, basically. If you imagine that an energy price shock, then it causes inflation to pick up. Wages follow with a lag. But then as that energy price inflation dissipates and then turns negative, it brings down headline inflation quite sharply. But wage inflation is meanwhile, causing inflation to pick up. And so you get this second wave caused but as the lagged effect of the negative energy inflation fades. So anyway.
So inflation is fading at the moment, continuing to fade. And wage growth is still high, though, which is also going to contribute to future inflation. Central banks continue to raise interest rates to maintain their credibility. And in the EU and US, central banks say interest rates have hit their peak. Whether they have or not remains to be seen, obviously. In the UK, we're not expecting them to have peaked. And we are expecting, in fact, waves of inflation, and that is going to impact interest rates and cost of living for some time to come yet, probably.
Okay, thank you, Richard. On to recession watch. Now, talking about the credit impulse, this is cumulative loan growth in the US for commercial and industrial. And you'll see negative year-on-year, massive negative credit impulse. And bear in mind that loans aren't spent immediately. That money is spent over time, and that will have an increasing impact over the second half of the year. And you look at leverage loan defaults, they are rising. Given we know that credit spreads are subdued, it seems astonishing that corporate bond, high yield bond investors are complacent about the potential default risk. This is the EU and the ECB's tightening cycle. And you'll see by historic standards, that is astonishingly fast and astonishingly large. And this excluded the ninth rate hike to 425 bips. A net 27% of EU banks said they have been tightening credit standards. And they don't really need to tighten credit standards, frankly, because actually demand has collapsed. So pause, take a look, but you'll see that demand across the EU for loans has fallen as interest rates have risen, and that will feed through to lower activity over the coming quarters. And this is credit demand for companies is white, for residential mortgages is in blue, and these are big, big falls. The mortgage demand has fallen to a low at one stage, it's down 75%. And as a result, the money supply, this is M1, has turned strongly negative. And if you believe this correlation, that means that the PMIs, manufacturing PMIs, should fall further from already terrible levels in the coming months. And the German manufacturing PMI, that is lows previously only seen during the pandemic and the great financial crisis. Really bad numbers. And in part, that's caused by secular declines, I would say, in German car manufacturing. So on average, German car production has fallen 20% since 2019. These are the numbers by individual car manufacturers. And I think it is no coincidence that Chinese car manufacturing has increased very strongly over the period. So you see, this is the market share of different car brands in China. Volkswagen, which was the number one brand, it's lost a third of its market share. And I'd suggest all of that has gone to BYD, Chinese brand. Sweden reported its GDP for Q2 this morning, and the numbers were terrible. Q2 GDP in Sweden was down 1.5% quarter on quarter, 2.4% year on year. Sweden is in recession. And we talked about this before, but what's interesting about Sweden is that it has a high proportion of variable rate mortgages, which means that the monetary transmission mechanism is fast in Sweden. And so it's fallen into recession now. I expect other Eurozone countries with slower monetary transmission mechanism to follow it in due course. Turning to the US, so talked previously about how leveraged loan defaults were rising. Well, we're getting more ratings downgrades in the US junk loan market, high yield loan market, but high yield loan yields continue to be incredibly low, which means that it looks like a default cycle has started and junk bond investors are indifferent, not paying attention. And Moody's are forecasting that there will be further defaults, particularly in the retail sector. Now, this is odd. So the Philadelphia Fed Services survey for June hinted at layoffs, and there was a big deterioration. But we've seen there have been no increase in layoffs. So this just seems to be an outlying data point, but worrying. Now, wholesalers have very high inventory levels, which means that it doesn't seem like there's any need for new orders from wholesalers, and suggests there won't be a quick recovery in manufacturing. And this is a really good and important chart. This is US diesel demand. Now, that suggests that actually economic activity in the US is weakening. I thought this was amusing. There are now fewer houses for sale in the US than there are realtors, i.e. estate agents. So you'd expect more job losses amongst estate agents. Goldman Sachs is forecasting only 1/4 of negative GDP growth in the US, and that is Q4. But the Fed, its recession gauge remains close to 40-year highs. And you look at semiconductor inventories, very high, also in recessionary levels. So in summary, we've had very weak Eurozone PMIs this week. Credit growth is also negative, and Sweden's already in recession. So I think it's very likely the Eurozone will enter recession in the coming quarters. In the US, junk bonds are being downgraded by the rating agencies, but junk bond spreads remain low. The market seems complacent, frankly, to an emerging default cycle. US diesel demand, really interesting, and suggests weakening economic activity. Leading economic indicators continue to forecast a US recession, but everyone is expecting a soft landing, and frankly, recent data has been reassuring. Okay, and on to US corporate earnings. Now, last week we showed you this chart. And this, we didn't understand it, and we asked you for your help in understanding it, and it showed US non-financial corporate net interest costs as a percentage of pre-tax profits, and they were collapsing despite the rise in interest rates. And that did not really make much sense. So the commentary from Albert Edwards was that during the pandemic, corporates had locked in long-term funding at very low interest rates. And so their interest bill wasn't rising while their profits were. So hence the collapse. But that didn't really make sense, because over the last year, a lot of corporates would still have had to refinance at higher rates. And I think Stephanie Pomboy has explained this. Now, what she's saying is that the data he's using comes from the Bureau of Economic Analysis national accounts data. Okay. And if you look at the annual interest expense of S&P 500 companies, well, it has actually been rising as we would have expected. So the difference between the national accounts data and the S&P 500 data is that the national accounts data includes all the companies in the US, and we know that there's been a rising bankruptcy rate. So therefore, this chart will include the interest expense of lots of companies which have gone bust and therefore are not paying interest anymore. And also those companies, they're probably losing money. So actually, once they get knocked out, you both reduce net interest costs and you boost profits. So in summary, we were puzzled by this, but it seems hopefully Stephanie Pomboy has explained it. Bottom line is, be careful of charts you see on Twitter and perma-bears. Richard, was that clear?
It was good, Keith. Yes, it's interesting, isn't it, that these things, how these things happen, and how if you don't understand them, then you can draw entirely the wrong conclusion from them.
Yeah. China, Richard.
Thank you, Keith. So China's real estate companies have cut investment, which is not surprising because we know the difficulties that they were suffering. And this is really a chart that shows a significant decline in Chinese real estate over the last year and a half. And we've covered this many times before. The property sector is a huge part of the Chinese economy. They're cutting investment. They have to. It's a bubble. And it's going to have a serious impact on the overall Chinese economy. Local governments have been increasingly indebted, and local government indebtedness in China is large and problematic. Clearly, that debt needs to be repaid. One of the ways they did repay it was by selling land to property companies. That's no longer a source of revenue for local governments. So Local governments are also in a bit of a bind. It's not clear about how central government can sort that out at the moment.
Yeah. And if you look at the pink line, it looks like local government bond issuance is on track to be pretty normal.
Yeah.
So they're just adding debts as they normally do.
So youth unemployment in China is climbing. It's gone on a steady ascent, and it's gone from 10% 5 years ago to 20% now. Pretty, from a societal point of view, it's quite dangerous.
Yeah, that's shocking, actually. Worrying.
The People's Bank of China's cut policy interest rates not as much as in previous years. And it has, of course, it said fiscal and monetary policy would be supportive. It wouldn't say anything else. But the problem it's got is how does it do it in a very highly over-indebted economy? Chinese household debt to disposable income exceeds the levels in the US prior to the Great Financial Crisis quite substantially. China's in a difficult, potentially dangerous situation.
And if you look at the speed with which those debts have increased, then it's been, it's taken them 9 years to go, rise by 60%. That's very fast, much faster than the buildup in US debt that helped cause the financial crisis.
Chinese inflation is very low, almost zero. And so that does give the People's Bank of China the room to cut interest rates further, weakening the yen and making imports cheaper.
It should be the yuan. Sorry, Richard. Weakening the yuan.
Yes, yuan. Weakening the yuan and making exports cheaper, which will export deflation. So in China, we've got this sort of ongoing problem where the CCP is concerned about stalling Chinese economy. It's talking about further stimulus methods. Its hands are a bit tied, and it has the best way of stimulating the economy is to reflate the property bubble, but reflating the property bubble doesn't really solve the problem at all.
Yeah, just kicks the can down the road.
It does, doesn't it? Yeah.
Okay, now, earlier in the year, we showed you this chart, which showed a strong correlation between financial liquidity and the performance of the S&P 500. Now, I won't go through the definition of financial liquidity, but if you're interested, please go back and have a look. Now, what's interesting is that correlation appears to have completely broken down. And we commented at the time that it didn't really seem to make much sense, because if the performance of the S&P 500 was entirely due to financial liquidity, then that implied earnings, news, investor sentiment, the macroeconomic background, etc., none of that mattered. So where are we now? Well, if you kind of expand the windows, it looks like that correlation existed for the period post-pandemic to 3 or 6 months ago at best, and really didn't work outside that period. So was that just a coincidence? It seems that it was, actually. And so despite the various people saying that the explanatory power was like 90% plus, it's entirely broken down. So the shows once again the danger of using explanatory variables that don't really make much sense. Richard,
there's a great deal of spurious correlation, Keith. One of the issues generally is it's so easy to create graphs these days of high-powered data sets that you can probably, the incidence of spurious correlations, I think, is enormous. And you look at a lot of these charts and someone says correlated, and frankly, there's very little correlation. Yeah. And if there is a correlation, there's no reason why there would be.
Yeah.
So moving on to soft landing watch. So US economic data is continuing to surprise on the upside, and the Citi's Economic Surprise Index jumped to the highest level since 2001 on better than expected data. And we're surprised. We thought that we would be in a much different situation to where we currently are. I think we still think we are. The US, the EU, and UK are heading for a recession, but it is taking a long time to come to pass. JP Morgan credit card data suggests modest growth in US consumer spending in July and no fall, although we have seen a reduction in credit card data, in credit card borrowing, which we saw earlier on in the podcast.
Yeah, and also we saw that the Johnson Red Book retail sales now negative year on year.
Yeah. So on this very brief soft landing watch, the US economy is continuing to do just fine at the moment.
Okay, thank you, Richard. Okay, and now on to the US housing market. So US house prices, we know, are very elevated relative to incomes despite extremely high interest rates. So you'd expect that house prices to be falling. They're about 31% overvalued relative to its long-term median. And in recent months, as we've been showing, house prices have actually been rising again, which is completely contrary to our expectations. So here just showing that actually they're pretty much back to their all-time highs. Their all-time highs was $414,000 and they're now at $410,000. Now, we've talked previously about how sales of existing homes have collapsed as homeowners refusing to sell and having to give up their low fixed interest rate mortgages. And so the inventory of homes for sale is very low.
Which is, of course, keeping the prices up.
Yeah, absolutely. Now, I found this interesting. The share of mortgages with very high interest rates is ticking up. And so you now have just under 20% of US homeowners with mortgages above 5%. So you'd expect that starting to bite. But when you look at the entirety of the US housing market, actually only 60% of houses have a mortgage. So when we talk about there being a lack of inventory, 40% of US homeowners don't have a mortgage and they could sell. They don't have to give up their low interest rate fixed mortgage to move. They are just not choosing to move right now. Recent home buyers are taking on absolutely enormous debt to income ratios to buy their houses. So this is the average. So some people will be taking on mortgages substantially higher than this and gambling that they can refinance those mortgages as interest rates fall in the future. And meanwhile, the number of multifamily units under construction continues to rise and is its highest level since the early 1970s. So at some stage, you'd expect some of these to actually be completed and come onto the market, at which point you'd think that the supply problems would ease and house prices will come down, but hasn't happened yet. So bottom line, US housing market continues to defy expectations. House prices are very overvalued compared to affordability, but recent home buyers have been prepared to take on very high mortgage payments in the belief that when mortgage rates come down, they'll be able to refinance. Bottom line, how long can that last? On to other charts, Richard.
Thanks, Keith. This is US drug deaths, which are running at over 100,000 per annum. And how many people can't work because of addiction or are very unproductive because of addiction. So this is a synthetic opioid problem, which is and fentanyl. It's a dreadful problem, and I think a lot of fentanyl is actually manufactured in China, isn't it?
No, there's an article in the FT this week about how a lot of fentanyl is actually being manufactured in Mexico now.
Is that right?
Very difficult to crack down on.
Yeah, I mean, very difficult. Seems almost impossible to stop it from being imported.
Yeah.
The NFT, a non-fungible token of Jack Dorsey's first tweet, which I have to say I would have paid 2.9 million for if I'd known it was around, is currently being sold for something between $4 and $47. Why anyone would want to spend $4 on it beats me, but
Yeah. Oh, this is fascinating. Years ago, you remember the Beanie Babes?
oh, vaguely, yeah.
Yeah. So there's this huge investment fad about Beanie Babes, which the toy manufacturer had discovered that you could make like these children's toys into collectibles by making them in small batches. Okay. And then, people wanted these limited editions of them. And this woman in the US started producing a catalog of different Beanie Babes and what prices were. And because, this was pre-internet, basically, because there was a lack of market information, the market moved to her prices. So she then became the price setter. And what I found interesting about NFTs was essentially there's no price information. People don't know what these things are worth. And so the first people to sell NFTs, when they set the price at, hundreds of thousands of dollars, that worked. The market went to them. They could, you could sell these digital images for hundreds of thousands of dollars. And now, as the market's matured, the true price has been discovered. It's about $4.
Yeah, nothing, effectively. Cost of packaging.
Yeah, well, and there isn't any. Okay, and on to good news. Well, this is the world's largest wind turbine with a rating of 16 megawatts. Absolutely astonishing. So the hub of the turbine is 156 meters tall. The blades have a diameter of 252 meters, which is like 2.5 football pitches. It's been made by a Chinese company, which, shows the progress in Chinese engineering, frankly. And it alone will power 36,000 homes. So, the Chinese, they are building lots of coal-fired power stations, but they are absolutely at the forefront of the green transition.
It's extraordinary.
Yeah. Let's see how it copes with the gale, is what I'd say. And on to equities, Richard.
Thank you, Keith. So the FTSE All-World Equity Index up 0.4% on the week, 15% on the year. It was a bit of an odd week for equities, as we'll see going through. So the FTSE was up 0.4%, 3% year to date, so hardly moved at all. And the Stocks Europe was up 1.5%, and this is despite interest rates being raised.
Yeah. What's happened is that Christine Lagarde, in her comments, saying that she didn't feel the need to raise them any further, seems to have set off a bit of a bull rally in the Eurozone.
Yeah, it's and then here we have the S&P 500, which is unchanged on the week, but and up nearly 20% year to date. And market's been a bit choppy, but the US market is still showing no signs of wanting to do anything other than continue on this upwards trajectory, I would say.
Yeah.
So the NASDAQ down 0.3%, up 34% year to date. Same comment.
Yeah. Is that topping out?
Well, it looks like some of the other little wrinkles you got on that curve, on that line, Keith, I would say, at the moment.
Yep.
Hang Seng Index up 4% on the week, so to be neutral on the year. Not quite sure why.
Well, the thing is, the reason it's risen on the week is that, the China's announced these, it plans to stimulate the economy without giving any details, but it's had a disappointing year because the Chinese economy is disappointed.
I always say, plan to stimulate the economy indicates the economy is a mess.
Mm.
And maybe the market going up. But I know who am I to say? I'm clearly wrong, because the rest of the world thinks differently to me.
Well, you and me both, mate.
So the topics up 1.2% on the week, because it's enjoyed the interest rate rises, and Bitcoin down 2.5% on the week, but still up 76% year to date. The pound up 6% year to date against the dollar, down a little bit on the week. And the euro down a bit on against the dollar. Oh, not very much away from unchanged on the year.
Yeah, the euro faded after Christine Lagarde's comments.
Yeah. I fade after Christine Lagarde's comments.
I thought you got excited, Richard.
The one thing that doesn't fade is Christine Lagarde's suntan.
Yeah, well.
And the dollar index up 0.6 on the week, down 1.7 year to date. So really very little change on the year, although it has dropped down below 100 briefly. And VIX up 6% on the week, but it's still really, really low.
Really, really low. Yeah.
Yeah. And the fear greed, I don't think that needle's moved very much from last week, has it? Everybody is still extremely greedy.
Yeah.
And consensus earnings estimates for 2023 continuing to be revised down whilst equities continue to rally.
Yeah.
And the only sector that's seen positive earnings revisions in this current year to date is the tech sector. And forecast earnings for 2024 also showing a similar pattern, with tech projected to rise and everybody else was projected to fall. Although the rally in the S&P 500 is now much more broad-based than it was a few weeks ago.
Yeah.
And earnings are up 7% year to date, after nearly half of the S&P 500 companies have reported their earnings.
These are Q2 earnings.
Yeah. And the equity risk premium is the highest since it's been since the GFC, with the forward earnings yield at 0.89%.
Yeah. So market is just incredibly complacent.
Yeah. And all the big banks in the US have done well.
Yeah. Apart from the investment banks, but the big retail banks done very well.
Yeah. And investment banks forecasting some big falls to the S&P 500, which is quite interesting, actually, because they are very in tune with what's really going on in the guts of these companies.
Yeah.
This is the point, really, that US stocks have done so well in the past that if there's any sort of reversion to the mean, they're going to do pretty badly over the next 7 to 10 years.
Yeah.
And cyclically adjusted price earnings, it's forecasting 4% annualized nominal returns over the coming decades, which is far less than we've had over the last couple of decades.
Yeah.
And the dividend yield is 1.5%, and you can get whatever 4 or 5 on government debt.
Yeah.
So the dividend yield suggests that the stock market is significantly overbought.
Okay, thank you, Richard. On to commodities and energy commodities. And Brent had a great week, up 4.2%. So is now down only 2.3% year to date. And WTI also had a good week, up 4.3%. Moving on to data specific to the oil market. Well, we had a tiny draw in the US, but the US oil market looks adequately supplied last week. US crude oil production fell by 100,000 barrels, but remains near its highs for the year. And because we did the last PM last Sunday, we haven't had an update on the rig count. Now, this is interesting. So this is from Rory Johnson on Twitter. And what he's saying is that Chinese oil demand is suspiciously high. So the black line, solid line, is this year's demand. And in all cases, for gasoline, distillate, naphtha, and LPG, liquid petroleum gas, and fuel oil, it is well above its 5-year range. And so what he's suggesting is that the Chinese are buying oil for storage, and that is unsustainable and flattering demand. So this is EU natural gas futures, flat on the week, down 62% on the year. This is the UK, similar story. US natural gas futures, down 4% on the week, down 40% on the year, but they seem to have bottomed. This is coal, up slightly, but down 66% year to date. And reminder that, yes, we've showed you earlier the Chinese wind turbine and massive investment in green technology everywhere, solar and wind, but coal consumptions continues to climb, and the Chinese last year were building 2 new coal-fired power stations a week. And uranium off its peak, but climbing back up 15% year to date. Industrial metals, Richard.
Hey, Keith. So we have aluminium, unremarkable, really. Cobalt, again, unremarkable, although the big drop at the start of the year wasn't, but from March onwards been unremarkable. Copper is actually looking at it as if it might try and break out above the intermediate peak it had earlier in the month. And I'm personally quite bullish on copper over the long term structural deficit, and it's just a waiting game as far as copper is concerned, in my view. Chromium, unchanged. Iron ore, really just virtually unchanged for the month, for the week, and for the year. And Chinese steel production has increased recently. Has the real estate sector bottomed? Well, I doubt it personally.
I doubt it as well. Well, let's just wait and see.
Yeah.
But somebody's using more steel in China.
Yeah.
Perhaps we know that they're completing stalled projects. So there may be an unsustainable increase in real estate construction.
Yes, that's true, Keith. Yes. There's lithium, which is unchanged now for a couple of months, effectively almost flat for the last couple of months, although it was down 6% nearly on the week. But that's a funny chart, that really. Neodymium, despite China using it for the world's largest wind turbine, it's flat. Nickel is steady at that sort of 2100 level.
Yeah.
Tin is just, it did this before, didn't it? So it sets out on these long marches upwards, and it's sort of looking like it's on a long march upwards again.
It does. And actually, I've included the very long-term chart.
Yeah. Oh, long-term, it's in a clear upward trend from 2000 onwards, isn't it? But very, very noisy.
Yeah. So I'm getting rid of the lead in solder means that, there's just, huge demand for tin in the electronics industry.
Yeah. Ferrovanadium, not really doing very much over the last few months. And zinc, likewise, so a little bit up on the week, but I think most of these metals are going to remain fairly moribund until there's sign of either definitive sign of a country going into recession or definitive sign of them having avoided recession and growth coming back. And precious metals, I think basically because it was quite weak in precious metals, a bit bouncy, but not a great deal of change, the 1.4% for gold. Price of gold diverges from ETF holdings. So the ETF holdings of gold is falling, the price of gold is rising. And this is it looks quite a reasonable correlation. It basically says if as the ETF holdings go up, the price of holding and down, the price of gold follows. But now what we're saying is maybe ETF holdings were the driver of the gold price, but something else appears to be driving it now.
Yeah, the suggestion is it's sovereign purchases
Yeah.
But, we were talking earlier about the, spurious correlations. Well,
Yeah.
correlations work until they don't.
Exactly. Yeah. And there's silver, unchanged on the year, basically. Platinum, a little bit down on the week. Rhodium, a little bit up on the week, but a big drop on the year.
Yeah.
Palladium, quite a chunky fall on the week. Looks like it may have further to go.
Yeah. The industrial precious metals not doing well.
No, they're not, are they?
Okay, and on to rates. Now, this is the UK yield curve, and it's shifted back up actually this week, having come down sharply last week after weak UK inflation. But everywhere, the yield curve shifted up, particularly last night after the Bank of Japan allowed JGB yields to rise. And I found this really astonishing, the extent to which there have been rises towards the long end of the US Treasury curve over the last month, given we know that US inflation is coming under control and it appears that US rates are peaking. So you would now expect US long bond rates to start coming down, assuming that higher interest rates bring inflation under control in the US. Now, in the UK, we have about 25% of our debt in index-linked gilts, and that means that RPI of 14.2% earlier in the year, in October last year, is causing the UK debt costs to be much higher than anywhere else as a percentage of government revenue, above 10%. Shocking. So the UK needs inflation to come down to stabilize its finances, government finances. In the US, this is odd. The inflation break-even rates have been rising. I mean, they're still relatively low, but given that inflation is now coming back under control, you think, then that is surprising. The 10-year bond yields currently implies a 3.5% return per annum over the coming decade, much better than over the last decade, as you would expect. And fund managers now appear to be overweight bonds, and fund managers are overweight duration, which appears to be the consensus view. Consensus views can be dangerous. Reminder, I am also overweight duration, and it ain't working. So this is UK 2-year. These are data before the open this morning, and because of the late sell-off in bonds last night, then they have all risen this morning. This is UK 10-year. Sharply down over the last couple of weeks, but rising again. Will be up this morning, same with 30. This is what happened in New York last night. There was a sharp rise in the US 10-year. German 10-year also rose. Italian 10-year, Greek 10-year. Any change to your views, Richard?
To be honest, Keith, I'm slightly wary of bonds at the moment.
Sure.
I think if we have I suspect we may see a bounce in inflation towards the end of the year, in which case I wouldn't be a buyer of bonds right now. And I think the market is clearly quite sensitive. So, yeah.
Yeah. Okay. So I'll move you to hold next week then.
Yes. Thank you very much. One thing I just wanted to mention actually on oil storage, I read the other day that the US has now run down about 500 million barrels from its strategic petroleum reserve. And that in doing so, it's damaged the reservoirs, which are salt caverns.
Wow.
And that it's going to be very difficult for it to refill its strategic reserve.
Wow. Interesting. So in summary, Both the US and EU central banks raised rates by 25 basis points this week. The Bank of England meets next week. PMIs on both sides of the Atlantic declined. The EU looks like it is heading into and may already be in recession. The UK looks like it's slowing towards recession. The US economy is amazingly resilient, but we attribute that to strong fiscal spending, which should fade in the second half. And we know the credit impulse is very negative in the US. So, Richard, what did you get up to this week?
Absolutely nothing.
Yeah. Very good,
There's a
right?
surprise.
Yeah.
So what did you get up to this week, Keith?
Nothing good, sadly. And so the P&L was a bit shit. Having had a good couple of weeks, fell again and will be very bad this morning as bond yields rise. So I was down 0.9%. All share was up 0.4%. I'm having a very poor year, but things will look bad until the economy turns over. And I think that point's coming. So I didn't buy, no buys, no sells, and there'll be no buys, no sells for the foreseeable future, frankly. Now, quickly talking about TR24, which you all know that we've been talking about previously, is we reckon it's got an annualized yield of about 8% if UK inflation comes in as expected. But its price has been drifting off mystifyingly over the last couple of weeks, months. But it matures on the 22nd of March next year, and the share price should now start trending towards 100, you would think. So I still think that remains a very good investment for your cash. Okay, that's it. Thank you all for watching. Now, quick piece of housekeeping. There will be no PM next Friday. I am off hiking again. I'll try and get something out, but it will be short next Sunday. We then have one more week of normal PM before we go on a big break of 3 weeks. Not much happens during the summer, frankly, and we'll be taking a break. Normal service resumes in the autumn. In the meantime, have a good week, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.